Good afternoon, everybody. It is Monday, December 28th, 2020, the last Stocks of the Week show. And we're going to talk about these stocks right here. So why don't we get started? Alibaba. Everybody is curious. What is the Chinese government going to do with Alibaba? I think it is pretty clear that they want Alibaba to split off the wealth management arm of the company away from the financial transactions and peer-to-peer lending portion of the company. It's basically splitting the PayPal side of Ant away from the, say, Goldman Sachs side of Ant. So ultimately, I believe that you're probably going to see a IPO of the wealth management division of Alibaba out of Ant, and you're probably going to see the main portion of Ant either stay as is or Alibaba will spin that off as well. Ultimately, I think we're right back to where we started with this company a couple of months ago before the Chinese communists decided that they didn't like Jack Ma challenging their authority and throwing a hissy fit like Cartman from South Park. Ultimately, I think that this is a rare redo to get a piece of a company that will almost certainly be $1 trillion company in the next few years. As we've been studying them, going all the way back to last year when I first recommended the stock at about $150 a share, the cloud side of the business is going to grow a lot, very similar to the way that it did for Amazon. So even if the rest of the business chops along, the cloud in Asia needs to be about 5 times larger than the cloud in North America. Alibaba's a leading player in that. I believe they have the largest market share, not only in China, but in the surrounding regions. So Alibaba just seems like a pretty natural play in a bigger part of the world to do similar things to what Amazon did. And with the valuation coming back dramatically, you're probably at a point where you should at least have a starter position in Alibaba. And I have orders to buy more shares at 192, right in there. Although if you really wanted to try to pick a pivot and you thought that maybe this was it, you could probably buy a second position here, right about where it trades. On the daily chart, it actually was up a little bit today, and it had a little bit of volume, right? There's somebody in there is buying the stock at this price. So could it be traders? Yeah, it could be traders. But ultimately, you have to value the company. If you think it's going to be over $1 trillion company and it's trading at $600 billion right now, that's quite undervalued. That doesn't mean it couldn't become more undervalued. It certainly could. You're dealing with the communists. Who knows what they do to punish it? But my guess is they punish the company. And as I said last week, I bet this volume of buyers includes Chinese communists. So just as the Bank of Japan and the Pension Fund of Japan manipulated the Japanese stock market and the Saudi Arabians manipulate the price of oil, I wouldn't put it past the Chinese to manipulate the price of Alibaba. You should get a starter position here if you don't already have one. My starter position is up here, so I'm underwater on it right now, and I'm okay with that. I won't add to it unless I get down here. I can wait to see if it gets there. From here to here isn't a big move up, just filling the gap, which puts me back to even. And from here to here creates a big enough gap for me to want to scale in again. One of the mistakes people make when they scale in is they do it too fast. You want to make sure that you get a big enough difference between where you start and where you buy your second position and your third position. So you could add a second position here and then a third position here. But to me, that's not a very big move, and I don't know when it's going back, and I don't know if it's getting to here first. So I don't need to add to this yet. And remember, I also own EMQQ, which is the emerging markets, internet and e-commerce, and its biggest holding is Alibaba. So it wouldn't surprise me to see both Alibaba and this ETF both go down to another level. And in fact, I have orders to buy EMQQ at 52. So when you think about these things, think about where you believe they're going to be market cap wise. And there's no doubt that this company should be larger than Amazon. The question becomes is should Amazon be as big as it is? But I think there's at least 60 to 70% upside from the current price. It may get cheaper, right? Alibaba may get cheaper. EMQQ might get cheaper. But there's a lot of upside because these e-businesses and this internet, the IoT that we've been talking about for years now, that's where the biggest margins are going to be made. Let's jump over to something else China related. MP Materials, the reincarnation of Molycorp, had a huge rally since I started talking about it in here, and it blasted all the way through what I thought would be the buy zone. And in fact, this ended up being fairly accurate. Got through this area, had momentum, got up to here, and now it's turning around. It looks to me that it's headed back into the upper 20s. And then what can momentum do? Maybe momentum takes it through this buyer zone all the way to this one. I don't think we see this again. So somewhere in the upper 20s to middle 20s is probably where we want to buy MP Materials. And again, why MP Materials? Because they're going to be part of an oligopoly in rare earth metals in the United States. And they're only about $3 billion in market cap now. I have no doubt in my mind that this ends up being a $10 billion plus market cap company. So you're buying the pullback because of what you see as a long picture, which is they're the only real mine that's active right now, and their processing plants is coming online. Rare earth metals right now that are mined in the United States and Nevada get shipped out to China, and then they come back. This will allow us to keep these metals at home. So MP Materials has huge opportunity. I think this stock triples from here. It wouldn't hurt you to take a starter position. I have orders in at 28. Let's talk about the rebound. I took a look at the cruise lines, and it was pretty clear to me that the best cruise line out there is probably Disney, but it's part of a conglomerate. Norwegian and Royal Caribbean and Carnival are the three biggest players. And the argument for Norwegian is that they're small with modern ships, and the ships aren't that big compared to, say, some of the giants from Carnival and Royal Caribbean. The problem with all these companies is that they have massive debt. So if we take a look at the debt to equity, you can see that it's not good, 2.7. All of these companies are just barely hanging on cash. Presuming the bookings aren't up to full speed until next winter, or maybe later in 2021, these companies have just piled on debt to pay for ships that they already had coming, and to try to pay people for a while, keep their companies together. The debt is just way out of line. So we have to figure out what should the price be given all the new debt. I think another recession in the next 2 or 3 years, even 4 or 5, would be really tough on these companies. So I'm not real interested in any of the cruise lines because of the debt situations, because they're all very economically sensitive. If I had to pick any of them, I would probably take a half of a starter position in Royal Caribbean and Norwegian during any bad week. But I don't think I'm going to own them because I think the risk is too high because the debt is so high. And the stock prices of 2019, they might not get back to for a very long time. A company I do like on the rebound side that I took off the probation list a couple of weeks ago is Delta Airlines. I think it needs to come back on a correction, but in the 30-ish range, here, where it started, it dropped, it paused, then it dropped again. 30-ish on Delta Airlines, I think, seems pretty reasonable. Presuming the vaccines are working. It looks like AstraZeneca is going to come to market next month. Merck over the summer. Novavax over the summer. So there's going to be a lot of people who, as I've said, I think everybody's feeling cooped up. I think that these businesses are going to do well. The reason I like Delta, again, their technology and their management seem to be better to me. They too have also taken on a lot of debt, so I'm very cautious. I need to get it very cheap. The market bid it up quickly. I think there's a pullback in order to 30-ish, and around 30-ish, I think I want to buy it. So that means I do in fact see about a 25% correction, which is in line with the 20 to 30% correction that I think that we're right on top of. SIRI we talked about recently. It's at the top of its buy zone. And again, this plays into the whole theme that I've been telling you about for a couple of years, which is subscription revenue. With these guys in 80% of cars, and now with an app from Pandora that takes them beyond the United States borders, they're going to expand internationally. And I think they're going to take a pretty big hunk of business from Apple and from Spotify. Why? Because if you like satellite radio, why would you use the other ones? Why wouldn't you just expand your use of Sirius and Pandora? Or if you're going to own two, why wouldn't Sirius be one of them, given that they have the widest range of entertainment? There's a reason why Warren Buffett owns a stake in this company. He also owns a bigger stake in Liberty Media Corporation's Sirius Tracker. You're getting some jitterbugging here, and I think this might be the spot to take a starter position. I've been trying to get it back down around 40, and it just hasn't come back. Would I love to get it at 35? Yeah, but I didn't know about it at 35. I didn't really understand what the deal was at 35. So this is the type of formation that could really go. Liberty is trading at a 30% discount to net asset value, which is really equivalent to their share of Live Nation, which puts on the concerts. I think in the first quarter, if we get a pullback, and again, I think it's happening, this is a must-own stock. To me, this is the rebound stock because of Live Nation. Now, you could just buy Live Nation, but I like the combination of Sirius and Live Nation in one holding, and I frankly like the financial engineering that Malone does over here because he uses these to make money. So you're on the same side as Malone. Warren Buffett's bought about 18% of the tracker. So if we get a legit pullback to upper 30s, I think for sure you buy it. And maybe we should even have a starter position here. Flipping over to real estate, I've been doing tons and tons of research, and the problem with all REITs is if you really want to know the company, you have to take a look at their individual holdings. Well, this company has about 45 malls, and they're higher end, urban, and I think they're going to do well as people go back out. Now, I'm not a big believer in malls in general. So as I've told you with regard to Simon, you've got massive remodeling coming. This company's malls probably have less remodeling to do. They do have some reliance on tourism, but I think that you probably see this run to around 30-ish in just the next couple of years. So I think that it runs up into this area where people were selling on the decline, and then it might even break out all the way back up towards 60. Now, they don't have a great debt picture either, but I think it's probably something that we should be very aware of. You don't get a chance to make between 3 and 6 times your money very often. And I think that might be the case here, right? It got crushed in the 2-year period, mainly because of what happened lately. But it's been coming back for 6 months. So this is another one where I think you buy it on a small correction. You say, look, they're doing pretty good financially. They've got free cash flow from operations. And they pay a junky little dividend. I think it's 4%, or it was 4%. And right now it looks like it's 5%. And I say junky because I'm not positive what it's going to be in a year from now. Will they add to it? I don't know. I don't know if they add to it right away. I think they extinguish debt instead. We'll see. But take a look at their properties. And if their properties make sense to you, I think this is one that could do pretty well. Taking a look at IoT and the cloud again. These REITs, Crown Castle and American Tower, look like they're turning over. And I was just taking a look at the financials for both. And neither one of them are super strong right now at this point, but they're pretty strong. You're looking for a technical reason to buy them cheap. Why? Because fundamentally they're pretty strong, but they're not dominant. Take a look at AMT right here. Good sales growth, but not awesome sales growth. CCI, the same deal. They both have good FFO, and they've got some forward dividend growth. For me to want this one, I'd want it in the 170s. Crown Castle, I'd want around 120. And it might not get much below 140. So you'd have to think about, do you want to own it in here? Go back and look at articles from a year or 2 years ago. You go, okay, if it's in here, this price level and time has elapsed, let's take a look at what makes these strong, what threatens them. What really makes them strong is that they're going to have perpetual income, and eventually their CapEx requirements will go down. Makes their margins better. I'm not really too concerned with NEO. If you want to chase a NEO, go ahead. You can deal with the communists. Yeah, absolutely no interest in this one. Just like I have absolutely no interest in Tesla up at these levels. Zero. Tesla and NEO cannot possibly sell enough cars to justify their valuations. Not in a decade, probably not in 10 decades. All right, let's call it a day, and we'll do covered calls and cash secured puts tomorrow.